Elon. Well, most people don't pay attention. Elon is already designing the future of humanity. Musk is changing the paradigm. Of course, everyone is freaking out about the stock drop. But here are some insights from the Motley Fool and also Investopedia, which are actually some of my favorites to follow. Both also always have some amazing information and insights. So today we'll talk about why Tesla stock is still an excellent investment. But first, let's talk about why the stock plummeted after earnings. Now, Tesla stock plummeted nearly 15% to $319.69 following an earnings report that missed profit estimates and revealed higher than expected AI and robotic spending. While second quarter vehicle deliveries beat Wall Street expectations by nearly 74,000 units, investors remain spooked by the compressed margins and aggressive capex. But it seems like investors haven't paid attention somehow, because Elon mentioned this a long time ago that there's going to be some incredible AI spending. So we knew it was coming. However, this is by the Motley Fool and it's their perspective. Of course, the bear and bull case when it comes to Tesla. Analysts at the Motley Fool shared a nuanced view of the electric vehicle and robotics pioneer. Let's talk about the bear case first. Analysts often argue that Tesla is overvalued when evaluated purely as an automaker, of course, citing its staggering price-to-earnings PE ratio and a safety-first robo-taxi rollout that has frequently delayed the timeline for mass deployment. You cannot expedite regulations, I'm sorry. But Elon mentioned that the Cybercab has to function 100% or it will be all over the news. And I agree. Now, let's talk about the bull case. Despite near-term margin compression, bulls are focused on Tesla's long-term evolution into an AI and robotics entity, especially its progress with the Optimus robot and unsupervised full self-driving FSD. And that takes capital. So the recent deliveries, Motley Fool contributors acknowledged that 25% year-over-year surge in Q2 deliveries was an impressive feat that helped the company hold its own in a brutal Chinese market, even if it wasn't enough to offset margin concerns. On July 23, 2026, massive capital expenditure plans triggered a broad retreat across technology stocks as soaring crude oil added to inflation fears. Now, the risk that the huge outlays on artificial intelligence AI infrastructure might not pay off pressured technology stocks. Rising oil prices and high treasury yields compounded the risk of mood. VTI crude oil gained 5.8% to $91.84 a barrel, and we know why. Well, mounting concerns over heavy AI captures expenditures hit both Alphabet and Tesla shares. Also, increased spending from both firms without a clear indication of when investors will see returns weighed on shares. Investors are shifting their stances on AI spending sprees, which could justify a more cautious stance in big tech firms. Now, we'll talk about why Tesla stock is still a good buy, and it's not investment advice. Hey, by the way, if you like this kind of content, please don't forget to like and subscribe. Thank you. So here is why Tesla stock is still a good buy. Tesla stock is considered a compelling buy by long-term investors primarily for its leadership in the transition to real-world AI and autonomous technology rather than its near-term auto profits. Now, bulls point to Tesla's massive capital investments as the foundation for future industry dominance in robotaxi, the Optimus humanoid robot, and FSD full self-driving subscriptions. And while the company's aggressive spending and price cuts on electric vehicle EVs recently led to a drop in operating margins and a negative free cash flow, the long-term bullish thesis rests on several core pillars. And here they are. Autonomous driving, FSD, and robotaxi. Tesla's shift towards AI infrastructure could enable a high-margin software and ride-hailing robotaxi ecosystem, shifting valuation away from traditional hardware manufacturing. Alongside deliveries of the vehicles, Tesla's energy storage division Megapack deployments has shown accelerating growth, offering a powerful and diversified revenue stream. By having one of the largest fleets of connected data-gathering vehicles on the road, Tesla remains an unmatched dataset for training and autonomous neural networks. For aggressive investors and growth investors, recent double-digit pullback following earnings misses offer a chance to buy into a market-leading AI and EV disruptor at a discount. And here's something that Investopedia mentioned about Tesla. An investment horizon targeting 2030 perfectly aligns with the bullish thesis for Tesla Inc. as it bypasses immediate automotive cyclicality and focuses directly on the commercialization phase of its artificial intelligence, AI, and energy projects. As of this recording, Tesla is currently trading at approximately $319.69 per share, following a sharp post-earnings sell-off driven by heavy AI infrastructure investments and compressed automotive operating margins. However, for an investor looking out to 2030, this pullback represents a unique structural entry point. Full self-driving FSD active subscription expanded 56% year-over-year to 1.48 million users. This built an increasingly high-margin, recurrent software revenue stream. Tesla's driverless ride-hailing service is actively scaling, operating across 7 major metropolitan areas, including Miami, Austin, and Houston. This moves the tech from a concept to a localized reality. Purpose-built Cybercab production has officially commenced at Gigafactory, Texas. This hardware creates a massive cost per mile advantage for autonomous transportation networks. Tesla deployed a massive 13.3 gigawatt hours of energy storage in Q2 2026 alone. This 40% year-over-year jump positions the energy division as a critical growth engine alongside vehicles. First-generation production lines of the Optimus robot are currently being installed. Internal scaling is targeted to streamline factory labor costs before commercial market deliveries. Capital expenditures more than doubled to $5.8 billion to aggressively build out computing clusters. This spending drag temporarily pushes quarterly free cash flow to a negative of $1.1 billion. Due to compressed near-term profits, Tesla's price-to-earnings PE ratio sits at an elevated 296. This calculation requires the 2030 software revenue to fully materialize to justify long-term outperformance. Structure a step-by-step 2030 allocation plan. This is also by Investopedia, by the way. Now, 1. Utilize dollar cost averaging, DCA. Break your intended investment into smaller monthly tranches over the next 12 months. Now, this approach captures lower average share costs while Tesla maneuvers through its high-spending AI phase. Set technological portfolio milestones. Continuously track structural progress rather than quarter-to-quarter auto margins. Monitor FSD subscriber growth, Cybercab production volume, and regional unsupervised regulatory approvals. Rebalance aggressive risk caps. Given Tesla's historical volatility, limit total position sizes to a specific high conviction percentage of your retirement or your growth portfolio. Let me know your thoughts. Also, I think Tesla's Q2 was pretty good except for the AI spending. Don't forget to tune in next time for more updates because I found some incredible news about SpaceX AI, and it was a real surprise for me. So I'll see you next time. Thank you so much and goodbye.